Recording live from the Hoban Law Group here in Denver, Colorado, I'm your host, Eric Singular. We're sitting alongside President and founder of the Hoban Law Group, Bob Hoban. Today, we're talking about why you need a specialized Cannabusiness accountant, and we are joined by co-founder and owner of Dope CFO, Naomi Granger. Naomi, thank you for being here with us.
Thank you so much for having me.
And Naomi, tell us quickly, how things have been impacted in Las Vegas, how you're holding up since this pandemic began.
Yeah, Las Vegas doesn't look so good right now. All of our casinos are closed down. However, they did consider cannabis to be an essential business, so the cannabis dispensaries have been able to remain open. But since Las Vegas is a traveling town, we depend on tourism, and without the casinos being open and without the tourism, a lot of these cannabis businesses are not seeing, great sales during this time, during this pandemic. Me personally, I've been pretty steady. Accounting, luckily, is pretty recession proof, and it's looking like cannabis, since we serve the entire U.S., is also recession proof when you look across the board.
Absolutely. Well, and let's jump right into it kind of on that note. Cannabis companies seem to need trained accountants more than ever. And this is especially true just because of the regular auditing that we see of cannabis businesses. And maybe you can speak to, at a high level, why it is so important for these businesses in this space to have a specialized accountant. What are the special needs?
Yeah, great. So, accounting for cannabis is different than accounting for any other industry. Cannabis is highly regulated. They have banking issues. They have software issues. There's just a lot of pieces that you need to be able to consider in order to do proper accounting for cannabis. I'm not sure how much we're going to touch on 280E, but that's one of the main tax codes that govern cannabis companies, which is just one sentence, but it says if you are trafficking a Schedule 1 or Schedule 2 controlled substance, which marijuana is still considered Schedule 1, you are still required to pay IRS income taxes. However, you are not permitted to take any of your operating expenses. And so they are still able to take costs, because cost of goods sold is part of the definition of gross receipts. And as a cannabis accountant, you need to really understand cost accounting. You need to understand the laws around what expenses can you allocate to cost. They are very stern and very strict on items that you can allow, items that you absolutely never can allow to allocate to cost of goods sold. And then there's other items that you can only allocate to cost of goods sold if you are doing GAAP accrual accounting, which accrual accounting is something that you typically don't see in a private business, or it's not required in private businesses. Typically, GAAP is something that's only required if a company is SEC traded on, is publicly traded and governed by the SEC, Securities and Exchange Commission. And so a lot of small accounting firms, they're not used to needing to keep their books in accordance with GAAP. But these companies are being looked at regularly, not only by the IRS, not only by their state regulators, but as well by the banks. If they're able to get a bank account, the banks want to see the books and records quarterly, and they want to ensure that things are being done properly. And so it takes a lot of work to do it properly in this industry.
Well, it definitely takes a lot of work, and I think that you do tremendous work as it relates to trying to improve the taxable rate or the effective tax rate for these businesses as they evolve. Early on when 280E became a focus in this industry 8 or 9 years ago, when we really started to focus in on the tax treatment of these businesses, certainly at our law firm, there were different accounting strategies around 280E. Some folks would say, well, we're just going to deduct all of the normal expenses, expect an audit, and then we'll just call this an unfunded future tax liability, and we'll grow into it in the future. That's not necessarily what I'd call an advisable strategy, although it was an early strategy. What are different strategies you've seen seen out there to deal with 280E? Some are aggressive, some are not as aggressive, and of course, those are the client's preferences, how they want to treat it. Do they want to treat this like an unfunded liability, deduct the expenses, and expect to get audited in the future and have a tax bill forthcoming? Is it about sequestering every single element of the business so that the cost of goods analysis only goes towards businesses that sell and distribute the cannabis versus, a business that might sell T-shirts and have other components to it that are outside of the regulated system? Talk to us a little bit about some of those strategy type discussions.
Yeah, absolutely. So, there are a lot of strategies out there. And what we're finding in many of the court cases, like there's many cannabis businesses that are wanting to challenge the court and see if they can get their strategy through. We haven't seen any wins. We've seen only losses since Champs. Champs was the first win back in early 2000s. And ever since then, most of these businesses have lost. Some of the strategies are, as you mentioned, having another non-cannabis division. So it could be T-shirts. Now CBD, since hemp CBD is now federally legal, that's more of a viable business. The reason why the T-shirt business and the vape pens and bongs business doesn't typically work out is because you might have, a $10 million cannabis business and a $100,000 T-shirt business. Well, you can't write off all of your operating expenses into your T-shirt business and have them the loss leader, because then the IRS will look at that and say, no, you really have a cannabis business. The T-shirt business is not substantial. If you have a CBD business, that's something that could be a little bit more substantial, and you can allocate more costs towards that CBD business and legally write those off. So we've seen that. We've also seen businesses that just have a ton of different legal entities. They have a management company, and they have a payroll company, and they have a leasing company, and then they, have a cannabis company, and they're trying to write off a lot of their costs into management company and a leasing company. Well, the IRS looks at substance over form. They look at the economic substance of that business. If that management company solely exists to manage your cannabis business, then that management company is a cannabis business, and that management company will also be subject to 280E. And so a lot of these businesses are getting into trouble because they're transferring large sums of money to this management company, and then they're being double taxed on 280E for their cannabis business as well as this management company. So we like to be as conservative as possible. We don't, like to play games. Right now, a lot of the laws aren't clear. A lot of the laws are still being shaped and formed. But we've seen in these court cases that these judges and attorneys want to make an example out of these cannabis businesses, and they're not allowing them to play these types of games. We would advise being conservative.
And we see these courts commenting, to your point, on, they're saying, well, look, if Congress wants this to change, Congress has to go change this. This is not something that we as courts necessarily should get in the middle of and twist everything, although guidance is necessary. In some of the things you said, I want to unpack at least two of those items. The first thing is sort of, what is an effective tax rate? And then I want to come back to the hemp issue in a moment. But when I hear people say, we don't make any money in the marijuana industry because of 280E, we're allowed to deduct very little. And then they say something like, our effective tax rate is X, and that's about as good as it can be in this industry. Can you describe for our listeners what that means? When someone says, what the heck is an effective tax rate, and how do you move towards improving that for purposes of increasing your bottom line?
Yeah, so your effective tax rate is just how much are you actually paying in taxes at the end of the day. After you've taken any deductions that you can, after you've, done everything that you can possibly do in order to calculate what is your actual tax. So the tax is paid divided by your taxable income. So that's just a simple calculation. A lot of these businesses, not only the reason why their effective tax rate is so high is because they're paying taxes. So if you're looking at a profit and loss statement, for just any business, you have income that comes in from all of your sales, And then you have any cost of goods. So if you're selling a widget, for $10 and the cost of that widget to you is $2. And then you also pay $3 in just operating expenses. Just for a simple example, you would be paying taxes only on the net of that, your net profit, which is $5. However, the cannabis business, they have to have that $10 widget, take away the $2 cost of that widget, and they pay taxes on the $8. And so when you look at these millions and millions of dollars of sales of marijuana, extrapolate that over, that's a huge difference between paying taxes on that $8 of the widget rather than the $5 after you've deducted all of your expenses. And not only do they have to pay taxes on that's called their gross receipts, sales minus their cost, but then they also have to pay state taxes. And a lot of these states are taxing marijuana businesses much higher than they're taxing any other business. So like the state of Washington is the one that I've seen out there that has the highest tax rate, where they're taxing them at 43.5%. So you've got your state taxes, and not only do you have your state taxes, you have your registration fees, you have everything that you need to remain compliant, and then cost of everything, cost of attorneys, cost of accountants, all of that stuff is a lot higher for these companies because there's just a lot more work. So that's why you're hearing these cannabis companies saying we're not really making much money because we're paying a lot of taxes.
So then I just want to unpack the hemp side of that discussion. So we talked about this. 280E applies to scheduled substances. Industrial hemp for restricted purposes was legalized in 2014, and then without any restrictions, it was affirmed to be 100% legal under our 2018 Farm Bill. Now, that 2018 Farm Bill also specifically states that the derivatives that come from industrial hemp are also 100% legal. And, for what it's worth, CBD's never been a controlled substance unless it's been derived from marijuana. That was a misnomer and a misclassification from the beginning. It was sort of this idea that the federal government, the DEA in particular, treated it as such or created that rhetoric for purposes of, putting the industry in a box so that it could get its arms around the operations of that particular ingredient industry. But coming back to my point, which was your point, hemp companies shouldn't be affected by 280E. Have you seen regulators? Have you seen folks at the IRS treat that differently, question that, or perhaps treat a CBD company differently because CBD is not yet regulated by the federal government, even though it is 100% legal?
Yeah, so I have not seen that. Now, they're highly regulated by, the FDA, by OSHA, but I have not seen the IRS treat them any differently. They are a legal business as long as you have less than 0.3% THC, and it has to be hemp-derived CBD, and you have to fall under the Farming Act. You have to be a business that's legal in line with the guidelines of the Farming Act. Then you shouldn't have any problems, and you can operate your business as if it was any other business.
Well, I want to come back to the marijuana industry really quickly. It looks like really in the last couple of months, the Treasury Inspector General for the Tax Administration, they released a document. It has a real long and unwieldy name. The growth of the marijuana industry warrants increased tax compliance efforts and additional guidance. And now this is a pretty lengthy document. I'm sure you've dug into it extremely closely. Can you tell our listeners what are some of the big takeaways from this audit that was performed?
Yeah, absolutely. One of the biggest takeaways from this audit is that there isn't clear guidance on the use. There's a code called 471, and it's in parentheses C, 471C, and it states if you read the tax code, that it states that a company can take a more aggressive position and allocate all of its costs to cost of goods sold. So we talked about this a little bit earlier, like what are some of the more aggressive positions we can take. Well, if you were to read this code section word by word, it sounds like they can actually take all of their costs into cost of goods sold and use that as their accounting treatment for their costs and not have any operating expenses. We have not seen this in court. I don't think that it would work out properly in court. However, what this TIGTA report indicates is that the IRS needs to come out with additional guidance to make sure that this is clear on the proper use of this particular code section.
Oh, absolutely. And do you think, kind of looking at some of the findings that were in this document and in this audit, that we might see an uptick in IRS audits of Cannabusinesses in the near future?
Yeah, so in the report, when you see the IRS's responses, a lot of times they're saying if it be, they're not really saying that they feel like any of this stuff is important, or if they have the resources, they will look a little bit further. Like the TIGTA recommended that they provide more guidance around 471C, and they're saying, as they see the need, they will. But TIGTA found that 59% of the businesses that they audited, so they only went to 3 different states and audited the businesses, and they found that there is an exposure of about $48 million of unpaid taxes due to either underreporting of income or overreporting of expenses and not properly following 280E. So we're now in a global pandemic. Many businesses across the country have been closed. A lot of state revenues, state tax revenues will not be paid. A lot of IRS tax revenues aren't even being incurred in order to be paid. And so there may be a possibility that there's an uptick that they can figure out a way to find more income to bring to infuse into the government by using these marijuana companies.
Well, and with that in mind, and we'll absolutely, need to bring you on again, Naomi, so that we can dig into this in more detail. But we've seen the Safe Banking Act come up a lot in conversations around, how cannabis and how this space can address some of the, rebuilding, let's say, I guess, of the economy. Quickly, what do you see? Do you see or perceive that the Safe Banking Act might catch some traction? And are there is there tax language in the Safe Banking Act that it would address any of the things we've talked about so far?
Yeah, so I'm hopeful that the Safe Banking Act will get passed. I know they included it in this next stimulus package bill. I'm based on what I've read, it doesn't sound likely that it will get passed, but it makes sense for the Safe Banking Act to be passed because there's just huge risk. You have these cannabis businesses that were deemed essential by many states, so they're open, they're able to service their clients for medical use. But if they don't have banking, that means that they need to transact using cash. And they say that cash can carry the virus for up to 7 hours. And so now you're putting these employees at risk, you're putting the customers at risk of catching this virus. And the reason why cannabis is considered essential is because it's medicine. And so the people who are going to get this medicine, they have autoimmune issues. So they're more vulnerable if they were to get the virus. And so it's very imperative that they are able to implement something where they can have more of a cashless transaction. And then just the state government and the IRS alone, you want to be able to, like, the reason why TIGTA did the report is if a business is transacted in cash, there's a high risk that they may miss some tax revenues that they're not going to be able to see. So it only makes sense for them to allow them to have bank accounts so that there's something tracking all the ins and outs so that they can properly assess if that company is paying taxes or not. So I'm not really sure. I don't even know why it's taking so long, or it takes a global pandemic to bring it back to the light. But hopefully it will get passed sometime soon.
Well, to your point, I just read an article, I think last night, that talked about 34 separate state attorney generals, bipartisan, supported this and said it's absolutely necessary for many of the reasons that you describe. So who knows? Maybe this is the thing that pushes it over the edge. But while we talk about COVID for a second, can you comment on the taxability, perhaps, of funds that a business may acquire by virtue of the CARES Act or the stimulus package? Are you aware if those dollars are taxable? For example, if a business gets, say, $500,000 to under the PPP portion, the payroll protection portion of the CARES Act, and they spend that money, 75% minimum on the employee payroll and related costs, and then it gets forgiven because it will be forgiven if you maintain a certain number of employees and you spend that minimum threshold, and there's certain other record keeping behind that. But how do you treat that money? Is that treated as income? Is that taxable? Is it expressly not taxable? What do we need to know there?
Yeah, so typically if it's a loan, like loans are not taxable because you'll have to pay that back. I know that there's a portion of the PPP that is forgivable, that they don't have to pay back. I'm not certain if that piece will be taxable or not. I haven't really dug into that.
Sure. No, that's a good point, because it occurs to me when you forgive it, right? You forgive $100,000, let alone $500,000. Yes, these are trying times, and it's a government stimulus package. But at the same time, unless it's expressly stated that it's not taxable, I wonder how you would treat it. So, interesting topic altogether.
Yeah. Absolutely. Well, Naomi, this is the first of many conversations and many times that I'm sure you'll come and join us on the Hoban Minute. These are issues that really affect all of us, especially here in the industry, and we greatly appreciate all the work that you do with Dope CFO and coming and enlightening us today. Thank you so much, Naomi.
Thanks, Naomi.
Awesome. Thank you so much for having me.
Thank you for listening to this episode of the Hoban Minute. Do you have any ideas for episode topics or guests? We would like to hear from you. Reach out to us at media@hoban.law and stay tuned for more on the Hoban Minute.